Good afternoon. This is Chris Robinson, Robinson Ag Marketing with today's post-close grain and livestock comments for today, Monday, October 20th, 2025. I'm going to lead off with beans. There's hopium out there, Hopium. We are smoking some hopium. More comments today. We've seen this before, guys. Right? We get a comment, a tweet, an idea. I will say this. It's nice to see us 38 cents off of where we were on our low on October 1st. That's number one. Number two, it's nice to see us above the 200-day moving average at 1029. It's nice to see us at a 2-month high. Excuse me, 1-month high. We're back to where we were September 19th. I wish it was a 2-month high. Lastly, I can't really get excited about getting long beans here aggressively until we, get above 1040, 1050. There's a lot of resistance out there. You got to remember, for the entire year, we've been in a $1.04 trading range, a high of 1075 and a low of 971. It was 1074 and three quarters, but that is really where we're at. So, and then again, a lot of farmers and producers, they always like to know, what's because the common lament about marketing is 70% of all the grain gets marketed in the bottom third of the available prices, right? Well, this so far this year, anything above 1042 would be in the upper 1/3 of available prices. When you've got a dollar trading range, there's not a whole heck of a lot to work with. But there's a lot of stuff going on there at 1042, 1050. That's my point. It's nice to see a rally. The managed money, right? The people you love to hate when they're bet short, they're actually building a small long position, very small, maybe 10,000 contracts here. Maybe they're trying to get in front of a Trump tweet as well. They have a small long of bean oil and pretty much everything else they're short. They're short 100,000 corn, 100,000 wheat, 100,000 soybean meal. Even though meals had a good bounce, again, I don't think they're going to get aggressive until we start taking out more major chart points. And that's it. People like to get excited about yields and carry out and exports. Exports have been very, very good for corn, and it doesn't really reflect in corn in the prices. Exports have been pretty good for wheat. Again, we're at contract lows, so sometimes people get caught up in that. It's wishful thinking. Um, we are in a market that's being driven by the carryout number one, and also just a lot of technical stuff. And people hate technicals. Trust me, the reason I started learning about technicals is because I realized how important they were even back in the late 80s, early 90s, and they're a big thing to watch, which is why I cover them so well and so often and so aggressively in my letter and in my approach. So it's nice to see a higher move here in soybeans. We do need to break out of this wedge. I posted about it today. If you're not getting my letter, go ahead and please sign up and take a look at it. If you don't like it, you can turn it off. There's no obligation, but sign up for a month and go month to month. It's the homework that I do, which I share with my clients time and time again. Again, what's at the top of that um, wedge that I'm looking at? Well, there's a couple. The first one I would look at in November beans would be if we could get past right about, I'd say, oh, yeah, 1042, and then above that there's 1048. So there's a traffic jam of stuff up there that we need to get through. But again, at least we're at a one month high here today. Good way to start the week. Again, where are we going to be on Friday? A lot depends on what happens with, our daily Twitter risk with current POTUS talking about what's going to happen at this Chinese meeting. Moving back to the corn, these corn pretty much unchanged in the day. 423 and a quarter, up 3/4 cent. Again, the exports have been great, but is it being reflected in the corn price? No. We're kind of stuck here in corn. I cannot get excited about corn until we at least go get the July 4th gap, which is up back there at 433, 432 and three quarters, which was the July 3rd low. And then above that, we need to get to the 200-day moving average, which is right around 438, 439. It is nice to see us above the 20-day and above the 100-day here in D's corn. These corn, the 100-day moving average, there's been a lot of congestion right here at this level. 100-day moving average right at 421. The 20-day moving average right at 420. The 50 days right in there as well. Again, the next big average that would attract some more short covering, because remember, the funds are still short of 100,000 contracts of corn. Now they could buy that back in 3 days if they wanted to. We just have to get in that situation, which that's going to depend a lot on the headlines here over the next week or two. In the wheat, though, again, I can't stress enough. We're coming off contract lows. We're 15 cents off the lows. It feels like we're $15 off the low, right? And we were just at a 5-year low a few trading sessions ago. 5 trading sessions ago. So to see a 15-cent bounce is nice. The level I'm looking at there is we've got to get above 506. There's a trend line there going back to the July highs. It comes down there. Now, why do these trend lines matter? I don't know, but they do. And if you're ignoring them, I think you're making a mistake. They're not perfect, but here's what they do. They give everybody a reason, bull or bear, to sort of make a new decision. So very, very key levels there to watch. A good way to start the week, at least with some green on the screen. Again, we are kind of captive to the tweets. Next good tweet, bullish. Next bad tweet, bearish. And that's why we hedge, because unlike some people out there, I do not have psychic abilities, or nor do I have a crystal ball, nor do I don't read the tea leaves. What you want to try and watch key support levels, key resistance levels. You want to try and keep an eye on money flow. It's kind of hard right now with the government being shut down. We're not getting official numbers of where these funds are bet, but they're your best guess by a lot of analysts are that they are building a small long in soybeans, and again, they're probably trying to get in front of a some sort of a Chinese deal as well. They still the Chinese, they're still in the catbird seat there, and behind it all, right? We're planting the South America is planting more and more acres of corn, more and more acres of beans because they want the Chinese market, right? They don't, this is a competitive worldwide market. They don't want to give up market share to China. Switching over to the livestock, um, interesting. The furred months and the feeders were lower. The spot month here, not the spot month, but the front month, November, up a penny, up actually just under a penny, 0.975, finished at 372.675. What's interesting about that, right? We're all following the tweets where President Trump's basically said he wants to, or his idea at least, is to bring Argentinian beef up here to help our supply problem and also indirectly help Argentina's struggling economy. Now he's doing that for geopolitical reasons. Um, they just sent out 20 to 40 billion dollars that they're going to try and help the president down there of Argentina pull through this. And again, this is all part of the broader strategy because the powers that be they're competing against Chinese influence down there. So part of the plan is just gave them a bunch of U.S. dollars on this last move. We just had the sale to China where all those beans got sold from Argentina that gave them dollars. So that's not going to go away anytime soon, and neither is the problem with the size of our herd. Even people, at the New York Times are starting to realize that there's something called a gestation period. I guess it's not like with human beings. With animals, I think they understand that there's a male and a female. With human beings, everything's fluid, right? That's the New York Times, but they've even come to the realization that it's going to take 2 years because of something called the gestation period. So this is going to be an interesting way to see if we can go get that gap. We did gap lower on Friday. We did not get into that gap in November. The gap comes in at 375.50. We got to 375.15 today. And then the gap does not get filled until we go back to the low there, which is 370, let's see, 379.10. So from 379.10 to 375.70, it's about a $3.50 gap. That's going to be what we're going to be trading here for the rest of the week. Are we going to fill the gap? Are we not going to fill the gap? Any way you cut it, we got a tremendous rally in the last 10 months. Um, I posted in my letter this morning, put it again. I've had it in the last couple weekly wrap ups as well. If you look at what happened in between 2008 and 2014, right? Go back there, cattle exploded. And then in 2 years, you know, cattle gave back a huge chunk of that rally. At some point, that's got to be the risk here if you're along a bunch of cattle and don't have any hedges. It's, you know, you look at what we've done since COVID, which was 2020. Here it is, 2025, 5 years later. You don't want to be in a situation 2, 3 years from now where you didn't do something to capture a chunk of this revenue up here. And finally, I'm going to finish up with the lean hogs. Very, very technical. We had a really beautiful rally from April to October. And then we've been sitting here at this 82 cent level here for a couple days now. Why is that important? Well, if you follow my letter, you'll find out about it. I concentrate on them because, again, they attract a lot of interest. If you take that low in April at 66.95, and you stretch it out to the contract highs there at September 26th, and then again on September 29th, 91.50. This level here, this 82 cent level, it's a 38% retracement of that move. Again, why do these levels matter? I don't know. I don't care why. I don't waste time wondering why. We just try and use them to help our clients do a better job of managing price risk. And again, if you want to learn more about that, sign up for the letter. Who am I and why should you care, right? Chris Robinson, Robinson Ag Marketing. I spent 18 years on the floor of the Board of Trade, started in the mid-am, and then went to the other room, traded pretty much everything at the Board of Trade that I could, where I could step into the pit and trade it. I was not a filling broker. I traded my own accounts and did that for 19 years plus. I would still be on the floor, honestly, if the floor mechanism hadn't got completely swamped and changed to the screen and so open outcry pretty much went by the wayside. So in between 2009 and 2010, I transitioned, started working with farmers and producers as a broker. So now I've been doing that for 15 years now. For the last 7 years, I started my own firm, Robinson Ag Marketing. Prior to that, I was with another firm. And let's face it, there's a couple dozen people that do what I do. There are a lot of brokers out there that can help you. What I would suggest is you find somebody that you trust, find somebody that you like, and make sure that you're hedging where you can. I would also suggest that you do a custom fit as far as it comes to hedges. It shouldn't be a one size fits all hedging approach. And I don't care if you've got 1,000 acres or 100,000 acres. It's all risk. And if you're not doing some sort of marketing plan, if you're just gonna store it and ignore it, or you're gonna store it and sell it when you feel like you have to sell it, it's generally not a good strategy. There are definitely some opportunities through the years. Now, this has been a very weird year, 2025, right? We peaked out on our highs in February. I can't remember the last time that happened. Also, for corn, our spring insurance price was 470. I think this is going to be the first time, certainly in decades, if not ever, where we did not get back one more time to that spring insurance price. So it's been a very, very weird year for marketing, a challenging year for marketing. And again, as we move ahead here with all the uncertain geopolitical risk, I think it's going to be more and more important that you at least take a look at hedges, which can protect you both before and after you make a cash sale. So if you want to talk about that, you want to learn more, sign up for my letter. 312-638-8868 is my phone number. I also do a weekly private client webinar, a podcast that's for members only. I'm about to send that out tonight. When I get done with it, we're going to dig deep into a couple of the hedges that we're looking at. So thanks for your time. This is Chris Robinson. Have a great rest of the day.